Tesla recently had a 3-for-1 stock split, and that has got the market a little excited. Like most stock splits, the stock has since fallen from over $300 to just over $280. This is Tesla's second stock split in 2 years, the first one being in August 2020. There are a lot of benefits from a stock split for both the company and the small investor. So let's take a look at them. 1. It increases the number of shares outstanding by issuing more shares to the current shareholders. 2. Stock splits can improve trading liquidity and make the stock seem more affordable. 3. A stock split can result in a share price increase, although there may be a decrease immediately after the stock split. This is because retail investors may perceive the stock as being more affordable. This effectively boosts demand for the stock and drives up prices. 4. Another reason for the price increase is that a stock split provides a signal to the market that the company's share price has been increasing. People may assume this growth will continue in the future. This can further lift demand and subsequently prices. 5. There is a psychological effect on the retail investor who feels that they now own more of the company, albeit at the same prices. This leads to a tendency to want to own more of the company, resulting in buying more stocks. 6. It has the propensity to attract retail investors that would not have ordinarily bought that company's stock due to its high price. 7. According to studies conducted by David Eikenberry, on average, companies who have had stock splits outperform the market by 8% after 1 year and over 12% after 3 years. 8. Stock splits can result in easier diversification, helping investors to rebalance their portfolios. For example, if you have 2 stocks of a company worth $4,500 per stock and the company does a 9-for-1 stock split, the investor can sell a few stocks at the new stock price of $500 to invest in another asset. 9. A stock split with a lower price has the opportunity to increase in value than a stock with a higher price. In addition, price increases have a greater impact since they account for a greater part of the stock's value. 10. The company can afford to issue more stocks at a cheaper price to attract talent into its organization compared to when the stock is quite expensive and finds it challenging to issue stocks due to such high prices. This is something investors generally don't like, but organizations use it to their own benefit. So those are the 10 benefits you can realize from a stock split. So let's take a look at this last week's portfolio performance. There were 3 portfolio changes in the last week. One was the Tesla 3-for-1 stock split. The second change is I increased my position in Palantir, as I mentioned in the previous week. And finally, I also increased my position in Genius Brands. For the month of August, the loss has further widened from last week and is now at minus 7.64%. The overall loss for the year is at 23.55%. The average risk score is still at 7, which is the same as it has been for the past 3 months. There are now 25.5 Tesla stocks in this portfolio. Palantir has been increased by 50 stocks, and Genius Brands has been increased by 200 stocks. The loss has further widened from last week and now stands at $4,500 on this portfolio. Taking a quick look at the portfolio dashboard, as you can see from the graph at the bottom right hand corner, there about half of the stocks in this portfolio in the negative region and half in the positive region. So over the last week there has been a huge sell-off in stocks as a result of the current economic climate. The percentage of the entire portfolio has changed as a result of increasing this portfolio's position in Palantir and Genius Brands. Taking a look at the overall portfolio performance, in the current week, the total portfolio allocated has increased from just under 35,000 last week to about 35,500 this week. The total portfolio loss has increased from $3,000 last week to $4,500 this week, and the total equity has decreased as a result of the sell-off last week, while the overall loss for this portfolio has increased from 8.5% to 12.75%. The performance against the S&P 500 had increased by 0.26% from minus 6.63% last week. Finally, the portfolio performance from the previous week is down a further $1,550. As you can see from the graph at the bottom right hand corner here, this is the second consecutive week of taking losses. So let's look at the portfolio performance against the S&P 500 for the past 1 week. As you can see that this portfolio is down 3.02% in the last week, while the S&P 500 is down 3.28%, so which makes them quite similar. In the past month, this portfolio is up 5.57% and the S&P 500 is up 1.76%. That means that this portfolio is beating the S&P 500 by 3.81%, and for year to date this portfolio is up 12.69%, while the S&P 500 is down 15.4%, making this a beat by 28.09%. Remember, this portfolio has been set up as an experimental project. It's not meant to be copied. The aim is to find out whether investing in a single sector, namely technology, with a limited number of assets in that portfolio in the long term over a 5-10 year period would result in a portfolio that has grown significantly, or whether it would result in a portfolio that loses investors' money. We are on this journey together, so why not like and subscribe to this video, as it helps this channel out, and I'll see you in the next video. Take care. Bye.